So welcome back, everybody, to another webinar organized by Princeton for everyone worldwide. We're very happy to have Antoinette Schoar with us. Hi, Antoinette. Good to see you, and nice to have you with us. Antoinette will talk about Bitcoin today and what regulators need to consider when they try to regulate Bitcoin. So I will give some few opening remarks, and then we pass on the floor to Antoinette. So when you think about Bitcoin, of course, the underlying technology is a blockchain. That's a way to keep track, to record keep. And there's an underlying ledger, which is decentralized. And the different ways you can keep ledgers and keep the records for various accounting systems, including for money. And there's so-called blockchain trilemma. You can either have two out of the three desired feature. You can have a self-sufficient system, which doesn't rely on outside verification. You can have something which doesn't need some resources, like resource efficiency, which blockchain doesn't have. Proof of work blockchain doesn't have because it has a lot of electricity expenditure, so it's a resource efficiency. Or you have a system which doesn't have no rent, so no rent extraction. So these are three desired features you might have. You can only have two. And if you have a proof of work blockchain like Bitcoin, you give up essentially the resource efficiency, and you have also, all the electricity expenditures plus the environmental damage associated with that. If you, for example, go for a proof of stake blockchain, you give up self-sufficiency, so you have to have some form of outside verification to have this. If you, on the other hand, have a centralized ledger, then the centralized ledger needs to be incentivized to correct, so he gets some rent. So there's a monopolist doing the record keeping, and he gets some franchise value coming from the rent he gets in the future that keeps him honest. And you can only get two of the three. Today, we will talk about proof of work blockchains, in particular Bitcoins, and you give up this resource efficiency and have these other two advantages on top of it because you have a decentralized system. Now, in terms of Bitcoin, we would like to know, is it a good what is it for? Is it a medium of exchange? What role of money does it satisfy? And the first problem is, of course, that it cannot handle the volume we typically need in terms of payments. So if you look at the credit cards used in the US per day, it's more than 100 million transactions a day. It's about 40 billion a year. And you cannot actually scale up the Bitcoin as much as you wish to, and at least in current technology. Now, what is emerging essentially is a two-tier system, as we are familiar with the regular system, where there's a Bitcoin blockchain system in the middle, and then there's some quasi-banks, I call them quasi-banks, attached to it. So most of the transactions will occur within the quasi-banks, or whatever you want to call them. And then they can actually across them, it's like an interbank Fed fund system, or whatever you want to call it, something equivalent, where then you can do it on the blockchain, but a lot of transactions can be scaled up then on within these banks themselves. But then the banks themselves are centralized ledgers, so the account keeping on the banks is then done centrally by the bank, and essentially you don't have this decentralized finance anymore. You don't have the decentralized blockchain, proof of work blockchain arrangement, because most of the transactions will actually occur within this banking system or this quasi-banking system. It's like a fractional reserve banking system, just using Bitcoin as a reserve currency, as reserves in parallel what we have otherwise. And of course, right now, just the BIS today came out with a new regulation that said if banks were to get into this business, regular banks, they have to actually put 100% equity at stake if they want to hold Bitcoin and offer Bitcoin and so forth. So it's quite a strict capital requirement on that. Of course, that's, bank regulators think mostly in terms of capital requirements, and they impose now 100%. At least consultation paper proposes this at this stage. Now, you might say it's not a good medium of exchange. Besides, if you build up this structure, but then it's not really a blockchain anymore. What's about, is it a good store of value? Can it keep a good store of value? And we come back to some points we came back many times in this webinar series. So the price of an asset is the expected present value of cash flows and the present value of service flows, plus some speculative aspect to it, which is, heterogeneous beliefs and switching beliefs, and speculation shows up in the third term. So it doesn't have any cash flows. So Bitcoin is not paying any interest or anything. There's nothing produced. There's no real asset behind it. So the cash flows are zero. But we have seen before, you can have a service flow. It can be a good medium of exchange. We just said it's not scalable, so it's not a good medium of exchange. But it might be a safe asset. It might be serving as a precautionary savings tool. But for that, it's actually too risky. So it's not really a good friend, what a safe asset is. A safe asset is like a good friend. It's around when you need it. So in times of crisis, it appreciates. And if you look at the correlation, what happens whenever you go in a crisis, and typically you can measure this fear gauge is the VIX. So whenever the VIX spikes, so that's, March 2020, when the VIX is spiking, then it should be a safe asset, should also appreciate in value. But you see that at that time, actually Bitcoin is going down. And now the VIX is going down and Bitcoin is rising. So it doesn't have this feature of a safe asset like what we associate with the US Treasury or with US dollar or also with gold. It doesn't have this feature. Now, you might say it might be a speculative asset. And one theory which comes to mind is a Harrison Krebs style bubble, where different people, different investors have different beliefs and they just retrade with some point optimists and pessimists. And when you buy something, you hope that somebody will be more optimistic down the road. You can dump it to somebody later on. And that leads to whenever this theory predicts, whenever the price goes up and the bubble rises, so this third term goes up a lot, then there will be a lot of more trading. And let's see whether that's the case. Whenever the Bitcoin price goes up, trading volume goes up as well. And that's, we can look at that. And that's indeed the case. So you have, the Bitcoin price is low and the bars are the trading volumes. And you see when the Bitcoin price goes up, the trading volume is going up as well. So that's a little bit misleading. You should not look at trading volume because even the price goes up. If you trade the same number of Bitcoins, the volume is going up in dollar terms as well. And so let's look at turnover. So if you look at the number of transactions as well, and you also see for the number of transactions going up when the price goes up. So there is some element to it. Whenever the price goes up, there's more trading going on. And that seems like, oh, there's more speculation going on. Finally, I would like to say a few words. Often it's said, unlike the dollar, it's not an elastic currency. That's why it fluctuates so much. So a fiat currency is elastic. There's a central bank smoothing things, the currency. That's why it's so smooth, the dollar, but Bitcoin not, because whenever there's extra demand, it just reflects by price increase. When there's less demand, it comes down. But this fixed supply is not a guarantee, because in order to have high value, you need also high demand. And if it's only the speculative demand, I'm not sure whether that's a good currency after all. Now, what's about stable coins? What's about financial stability issues? And of course, Bitcoin is just one. Let me move to some other broader perspective. Of course, we have also stable coins which are pegged to the dollar or pegged to the euro, and the most famous one is Tether. And the difference between Bitcoin is, of course, they are backed, supposedly backed. So there is some dollar value behind it. So they buy typically commercial paper. If they're not fully backed, then they are runnable because there's they're subject to a bank run essentially, because they do some maturity and liquidity transformation. They issue some dollar claims and then invest, which is redeemable in very short notice, and they issue by some longer term bonds or what other assets. And that's actually going on. And supposedly Tether has more than $30 billion now in commercial paper, and that's a giant in the commercial paper market. So if something goes wrong, if there's a run on the Tether market, it may immediately spill over to the commercial paper market. And that's something one has to watch out for in financial stability considerations. Of course, one way to regulate this is to make them narrow banks. So Tether could be a narrow bank and has to hold 100% of its issuance in US reserves, or indirectly through some bank, some other intermediate narrow bank. And this way there would be no run risk, because essentially the US Federal Reserve would standing behind it to back them up if there's a run, and it's fully backed one-to-one. And finally, and I think Antoinette will talk more about this, is about crypto assets. It's an asset class. There's a lot of ETFs floating around, more and more, especially in Europe, out of Luxembourg. The risk is building up on that side. And, these ad ETFs might be runnable, and there might be ripple-on effects if suddenly there's a run. All the assets these ETFs are holding and underlying them, there might be a run on them as well. Now, let me conclude with a final thought. Is Bitcoin advantageous or is it dangerous? I think it's like any innovation. It has positive and negative sides. It's like dynamite. I can build some tunnels and I can also fight some wars with that. So that's true also for all this new payment and money aspects, and it's exciting for researchers. But I think one thing one has to mention for sure, that it has triggered a payment revolution, and it is a catalyst for bigger change, and it helps millions to be included in the banking system. It will help millions of workers to make some payments abroad much more cheaply. So in this sense, it has big positive aspects. It served as a catalyst for big positive changes and innovations. And I think we have to look out for regulation, not to stifle this innovation, but also take care of the financial stability aspects. And Antoinette will focus on that. So let me conclude with the outcome of the poll. So the first question was, somehow I don't have a slide now, but the first question was, what is most likely use case for Bitcoin? And is a transaction medium of exchange, 13% that is. Store of value, only 8% says it's, and speculative asset, 79%. And I did a similar thing on Twitter using Antoinette's question. It was also 80% purely speculative asset. So what stands most, stands most to gain if institutional investors like mutual funds, ETFs, and pension funds were allowed to invest in Bitcoin? Early adopters, 65%. Say the broad public, 6%. Seems like broad public is not gaining at all. And the asset management industry, 29%, so 30% almost. And the third question Antoinette put forward is, what are the biggest risks of wider Bitcoin adoptions? Is it an environmental risk, 20%, tax evasion, 12%, systemic risk, 29%, and facilitating illegal activities, almost 40%, 39%. So that's the largest number, followed by systemic risk, environmental risk, and tax evasion. So with this, I leave the floor to Antoinette, and we're all curious to figure out how we should regulate crypto assets, crypto coins, and Bitcoins, and the whole universe. Thanks,
the whole
Antoinette.
Universe. That's a big stick. Thank you very much, Markus, for giving me the floor, and it's a real pleasure to be with you all today. Let me actually share my screen so that you can see what I'm going to be talking about. So yeah, what I want to do today is kind of building actually nicely on Markus' introduction, is to give you first the state of how the Bitcoin ecosystem looks as of today, and in particular who the major players are and what we can know about them and how they are transacting. From this, I will build up for you what we have seen are currently the main use cases and drivers of value. And as I think the poll already very, very rightly said, currently it's really mainly a speculative environment. And I will give you some argument why, given what I've seen, kind of the current ecosystem, it might be difficult for this particular type of proof of work cryptocurrency to ever go beyond this type of speculative dimension. And from this, I want to then give you some arguments about the dangers of wider Bitcoin adoption. And what I mean with this is basically, we have seen that there is a lot of pressure on regulators right now to allow the use of Bitcoin for either even, kind of legal tender or ETFs, mutual funds, pension funds, to allow retail investors to go into this. And I actually believe, given what hopefully I will convince you once you see the crypto ecosystem, the Bitcoin ecosystem and where it is right now, that this would be actually a very risky experiment to run with, kind of with public money. let me acknowledge that, this work is, a lot of what I will show you is work I'm doing with my co-author Igor Makarov. And I'm also building on a white paper that I wrote with Leonid Kugin, Andrew Lowe, Igor Makarov, Bob Merton, Jonathan Parker, and myself. And a special thank you to our RA, Jagang Lu, who has done tremendous work with us on this. So without further ado, right, Markus already actually highlighted this, right? Cryptocurrencies like Bitcoin that are proof of work, have a proof of work blockchain protocol, allow the verification of pseudo-anonymous transactions in the absence of a trusted party. But with this, obviously, then they have very high electricity consumption due to the built-in mining incentives. And I just want to be very clear about this. I'm not going to bore you kind of looking at the blockchain for hours, but I just want you to understand what it means when people say Bitcoin is traceable. What is traceable is how transactions flow from one address to another, and how much, say, kind of BTC is flowing to different addresses. And that you can trace, and you can trace it back in time on the blockchain. What is not traceable per se is who the entity behind the address is. And in particular, right, what we have seen is that if participants on the blockchain and these addresses never touch another address that actually enforces KYC norms, then you can stay anonymous. So, kind of basically the idea is that while I can trace the flow of money, I don't necessarily know who is behind it, and I won't even know when say Bitcoin moves from one person's wallet to another person's wallet, right? It could be that I'm just transferring between my own addresses, or I'm, kind of paying for another transaction. I will come back to this, and this will be actually really important because one thing that we see is that currently, when there are not so many, allowed users of Bitcoin to pay for goods and services, right? In fact, in order to cash out your BTC, most people go to exchanges or payment processors, so a few nodes where you turn basically Bitcoin either into cash or other currencies. And here, right now, there's a lot of push, of course, to enforce KYC norms or the implementation of KYC, know your customer standards on, say, exchanges like Coinbase and so on. What I would like you to keep in the back of your minds is that if Bitcoin becomes very widely accepted and adopted, then we will be in a situation where it's much easier to bypass regulated entities and entities that enforce KYC norms, because you can then go to many places that are somewhat more shadowy or kind of less regulated, and therefore it becomes less and less expensive to be anonymous on the blockchain. So this is actually a dynamic that often is not so well understood, but it's very important. So, and also I want to say one thing very quickly, because this morning, kind of we've heard that, the FBI traced some of the ransom payments on the blockchain. It didn't trace it. I mean, it traced it on the blockchain, but actually that is meaningless. What they did, and that's very important to understand, is they hacked the hackers. So they got the password of the addresses of some of the hackers underlying the ransom attack. That is not a feature of Bitcoin, right? It's actually a feature that we normally don't want if you are a Bitcoin holder, that somebody hacks your account, right? So this is actually really important to understand, because it, kind of, you should not confuse what is actually traceable in terms of just the flow versus the identities. All right, having said this, Markus already said so I will be very short here, right? We know Bitcoin is extremely energy inefficient due to the mining incentives. And just to give you a magnitude ranking, right now, if it was a country, Bitcoin would rank somewhere between Malaysia and Egypt in its kind of energy annualized energy consumption. But let me not spend too much time on this. Let's move on, right? Given that we understand the kind of how the ledger itself works, let's talk about the main participants in this ecosystem and their incentives and what we can know about them. And in particular, I will talk about miners, the largest holders, or Bitcoin enthusiasts like to call them hodlers, on the network, and then the interaction with exchanges and other payment counterparties. So the first thing to understand, right, is miners, you can think of them as the verification backbone of the Bitcoin ecosystem. They are verifying all of the transactions, and the way it is typically done is that we have miners loosely, in a way, moved, are together in what is called mining pools. The reason is that, kind of by allocating together in mining pools, these mining pools provide co-insurance by pooling the capacity of miners. And they often provide payments, kind of in this insured fashion. This means that mining pools are relatively important within the Bitcoin universe, and there are a number of papers that have already, kind of noted that, mining pools do play an important role by bundling the mining capacity. We know from public sources that the majority of mining pools, mining pools are relatively concentrated, as you can see here, kind of the, say, 7 largest mining pools make up, the vast majority of the mining capacity, meaning, the transactions that get mined. So they are very highly concentrated. Also, the majority of that capacity is registered with pools in China. And, kind of some people have noted that, kind of can create issues for the Bitcoin environment if, say, Chinese regulators crack down on these type of activities. It's also been noted that a lot of the mining capacity is actually tied to Bitmain Technologies, which is one of the largest providers of hardware for mining activity. Now, what's important, and this is where I want to drill down on now, is that mining pools are not miners, right? As I was saying, mining pools combine often the mining capacity from many underlying miners, and those miners can sit anywhere in the world. Even if you work with, say, F2 pool or Ant pool that is, kind of registered in China, you as a miner might be sitting anywhere else. And so these concerns about how concentrated is the actual mining capacity and how fluid that does this mining capacity move between different mining pools becomes very important. But to know this, we actually need to trace mining pool distributions down to the actual miners. And therefore, we have to identify miners based on their pool distribution. So in an ongoing project that I have with Igor Makarov, we have done exactly this. We traced the pool distributions to individual miner entities. And will therefore, now I show you how concentrated the mining capacity underlying these pools are. And what you see, which we were actually very interested and surprised to see, is that mining capacity itself is also very concentrated. So what this is basically showing you is over the last 5.5 years, so to speak, how does mining capacity allocate itself across the top N miners. And so if you look, say, at the blue line here, this is saying that to cover 50% of mining capacity, right, which is close to the 51, basically, kind of attack threshold that everybody is very worried about, on average, it takes less than 100 miners. And say if you go to like say 40%, right, it's even, you know, kind of across this entire time period, even, you know, say the last year, right, it's actually much fewer than 50 miners, typically actually fewer than 25 miners. So this is actually saying that it's not just the pools that are concentrated, the miners themselves are also quite concentrated. And the other thing I want to take for you to away from this, which is also quite interesting if you think about the robustness of the verification mechanism behind it, is that the concentration moves vastly with the price of Bitcoin. So in times when the price drops, you know, capacity seems to leave the industry, which is kind of obvious, right, given the incentives. But it also means that therefore the robustness and the competitiveness and the decentralization of the system itself, you know, is endogenous to the price movement and becomes potentially more open to hack attacks, right?
So Antoinette, can I ask a quick question about
yes,
the China component? If you look at these numbers, did you also say what fraction is done in China? Can you?
That's a great question, and you're moving me along.
Oh,
thank you so much, Markus. So this is my next slide. Now, so Markus rightly asked, right? We want to know how regionally concentrated these miners themselves are, because then you worry, right? We've seen many governments are trying to regulate this industry differently, or even, you know, kind of crack down on mining activity. Some of it because, you know, in China, as we know, you know, kind of the government is becoming very worried about the cost of energy that's subsidized, and they might not want to subsidize mining capacity. So as I was saying before, right, it is not easy to trace miners in terms of their identity. What I've showed you before, right, is exactly, I traced the flows on the blockchain, and I can tell you that's by itself not easy. But I can basically see the miner sizes through the capacity, through the rewards, Coinbase rewards that are being given. Now, in order to infer that whether a miner is US based or China based or, you know, European based, right? They don't have a, you know, kind of a label on their head. So what we do in order to look for that are two things. Here I show you, because I know those miners and the Bitcoin that's sitting in their accounts, I can see where do they go to cash them out. And so then I'm making here basically the assumption that if you are a miner who mainly kind of cashes your Bitcoin on a China-based exchange, right, then you are more likely to be also located in China. While if you are going, say, to a Korean, Japanese, or, you know, kind of US-based exchange, you are more likely to, you know, kind of be operating out of one of those areas.
What fraction is cashed out? Sorry. Do they cash out a lot, or do they just keep the Bitcoins they mine?
Excellent question. So this is saying the fraction that is cashed out, where is it cashed out? And here basically I'm showing you, right, that the, you know, almost 60% is basically China-based miners, and then, you know, kind of another maybe 15% is Tether, which, you know, kind of, as you said, is a stablecoin where we could be a miner sitting anywhere, right? But you're right that actually there are many, especially very large miners, who are sitting on Bitcoin. And so they're not cashing them out immediately. In fact, we have a little bit of evidence that the smaller the miner, the more likely they seem to, you know, what we might think have liquidity constraint, and therefore are cashing out very quickly, you know, independent of price movements, while the largest miners seem to actually, first of all, cash out a smaller fraction, but also seem to be kind of, in a way, trying to time the Bitcoin prices more, you know, kind of so that they're trying to trade contrarian. Yeah.
Can I ask another question? Sorry.
Absolutely.
When you buy this equipment, this mining equipment, can you pay it with Bitcoin, or you have to pay it with dollars or with a regular currency?
Good point. So you can pay it with Bitcoin, it seems, as well. And we actually go through a lot of trouble. Maybe that's where your question is, right? To try and separate what are the payments that are done truly from the Coinbase rewards versus what are things that are being paid for that are other services that, say, a pool might do, or kind of say Bitmain might be providing to the miners, right? Absolutely.
And this figure is only for Bitcoin, or is it for all crypto?
No, so this is only for Bitcoin, because right now, kind of we are basically working on this one blockchain, which right now is painful enough, but we are hoping, kind of to keep on going. Yeah, so this is what I would like you to take away from this, is that the mining capacity is very concentrated across a few miners themselves, and it seems that the geographic concentration of miners is relatively high, in particular is based in China. Now, the other big participants in this ecosystem are what Bitcoin enthusiasts like to call hodlers, right? Basically, large owners or holders of Bitcoin. And here, why I want to show you this is that there is this perception that with, over the last maybe 5 years in particular, with wider adoption, that somehow the ownership of Bitcoin has become, very decentralized, or, lots of people are participating and so on. But what I can show you is that actually the ownership is still very concentrated. And this is kind of here, what we're doing is we are showing you the concentration of the largest Bitcoin addresses that are, that are not tied to, say, either exchanges, OTC brokers, kind of any other more, or say ETFs like Grayscale, because of course, right, say if I showed you that Coinbase's cold wallet, kind of has 60 million, whatever, $66 billion worth of Bitcoin in it, you would be like, so what? That doesn't tell me anything, right? Because it could be either owners in Coinbase, but it could also be lots of participants, right? People trading on exchanges. And it's, by the way, very important to understand, when you trade with an exchange, you're giving up your actual ownership of Bitcoin, because your transaction will not be on the blockchain anymore. It will be now in the cold wallet of the exchange, right? But because of it, once a Bitcoin enters into an exchange, I cannot trace ownership concentration anymore. And so I leave, all this out. So as I said, exchanges, payment processors, these type of aggregators. And what I'm showing you here now is just the concentration of the largest individual holders that, from their trading patterns and interaction patterns that we see on the blockchain, are very unlikely to be basically aggregators for other people's money. And even then, right, when I narrow down to, kind of those very restricted accounts, you see that, say about, right, 10,000 owners or large holders hold about 2 million BTC, right? So you basically can see there is really kind of a lot of concentration. Or you go to, right, or you go to 10 to the power of 4, right, you see, kind of almost a quarter, right, of BTC is basically held by a very small number of people. And by the way, I also want to say, in this, we are being sure, kind of, you can even break it out into accounts that have never transacted. Kind of, this is not just lost Bitcoin that is somehow a wash. These are actually addresses, where you can see that people are transacting. So again, it's the miners themselves and the owners, or the largest owners, are still extremely concentrated. And, kind of, why I'm going on and on about this is actually that when you then think about wider adoption, right, the question is really who would benefit if we were to move towards making a currency like Bitcoin legal tender. And then let me show you a final type of information that you can glean from the blockchain. And what you see here is that we are tracing the transactions on the blockchain to different entities. So for example, right, especially the big blue bin here are payments between exchanges and other types of payment processors. The greenish line is are OTC brokers and other larger traders, where we might not know whether it's Binance or Coinbase or what have you, but they're based on the trading activity with other exchanges. We can infer that this is used for trading. And then I also wanted to show you just the amount of volume generated by Bitcoin miners and illegal activity in gambling. So this is to show you that the vast majority of current volume on the blockchain or current utilization of Bitcoin is for trading activities. So this is, 40% is just literally trades between different exchanges to each other. Same thing, the green line for, different brokers if you want. If I now added also the volume of individual addresses trading to and from exchanges, it would actually go up to almost 90%, speculative or trading activity. And
Antoinette, if I think of PayPal, you can also pay now with Bitcoin using PayPal. Where would it be, in the blue or in the green part?
If you were to do it with for PayPal, because PayPal is so recent, it would actually not be on this in my data yet. But if it was, I would put it into green right now, because they're not officially an exchange. But again, remember, even say with PayPal, it would be that you are forfeiting your Bitcoin to PayPal when you trade with this. By the way, PayPal actually is doing a very careful job right now in navigating, the regulatory environment. So you cannot right now trade in and out your Bitcoins from PayPal. So So PayPal actually, in a way, is doing the transactions for their customers, and therefore is making sure that you are abiding, say, by KYC and taxation. Yeah. All right. But what I want
just to make sure that I fully understand the figure, if I stay within the Bitcoin universe, where would it drop? And if I move out into the dollar space, both of these are different transactions. One is I can just trade with somebody. So you capture both aspects here now. Yeah, exactly. So I would capture everything, right? And what I'm in a way showing you here is that, say, what you're saying about dollar, right? This is some of, say, the illegal transactions would be of that type, but so would be the miners, right? They receive Bitcoin and then they go to, say, Binance and they sell Bitcoin for dollar, right? So here you would basically see that a transaction where some miner that works with Enpo, let's say, I would see the transaction of going into Binance, and then they might sell it for dollar, they might sell it for another coin, right? That would be only visible on Binance, yeah? And that's where I would lose them. But say if an illegal transaction or a miner goes to Bitmain and pays for equipment, that could be a transaction here. And in a way, what this tells you is that these type of direct between entity transactions that do not involve an exchange or payment processor in between are right now extremely small in terms of volume. Yeah, extremely small. That doesn't mean we should minimize them, right? The fact that ransomware and so on is or Bitcoin has become the unit of choice, so to speak, for these type of attacks is not good news, because it does, in a way, again, confirm that at least, these illegal entities seem to think that it's their best way to hide. Anyway, let me now turn to, so that I think people now have a better sense of, what are the entities involved and how are they transacting. Let me now come to this question of
what are the drivers of value and the use cases of Bitcoin. And this also speaks to some of the things Markus was saying before, right? How much do we think will Bitcoin become a valuable store of value, or will it stay a speculative asset? I think, given our previous discussion, it's clear that it's just the transaction costs and the speed of are too high, and the speed of settlement is too slow for it to be, say, a meaningful payment mechanism of, kind of the high frequency transaction type, as credit cards or other payment processors are. So what I want to show you is now what we have learned over the last 2 years in particular, I would say, about some of the statistical properties of Bitcoin returns that, at least for me, make it somewhat questionable that Bitcoin would be a very meaningful store of value. And so
Antoinette,
here,
can I come back to one question which came about, perhaps you can say something about the payment aspects, because El Salvador just adopted Bitcoin as a legal tender. Do you have any reaction to that, in a sense?
Can I hold off? I think this is a really interesting question. Can I hold off for this for
Sure.
5 minutes? And I promise you, I absolutely get there. Yeah. But just, kind of in terms of, if we want to think about store of value versus just speculation, some of the statistical properties of Bitcoin that we have seen and that are persisting, despite the fact that Bitcoin now has very high market capitalization, makes me very concerned about it being a useful stored value. So why do I say this? So number one, right, in a paper that Igor and I have in JFE in 2020, we show, for example, that there's very high and persistent price impact from flows in the Bitcoin on Bitcoin exchanges. So a net buy order of about 3,000 Bitcoin, $100 million at the time, leads to a price impact of 1%. And we've obviously also seen that just sentiment-driven announcements, right, have massive effects. Now, why this is particularly concerning in my mind is, of course, as I showed you, that there are some very big holders or hodlers who can create a lot of price impact if they so chose to, with relatively little effort and very little traceability, if indeed they chose to, right? Related to this, we have seen actually that the volatility of Bitcoin has stayed extremely high, even when the market, or as the market cap became as high. So this is the 5-minute annualized volatility that I'm showing you, over the last 5 years. And you see, there are massive spikes and it hasn't gone down, right? Those are not typically good features of a store of value. Now, the other two dimensions that people have mentioned is, early on, it looked as if Bitcoin had very little correlation in its returns with other market factors, including even commodity movements, right? Risk factors that we care about in the stock market and so on. But especially over the last year and a half, it seems that this correlation is actually rising. And many market participants have pointed out that, especially now on the downside, in kind of times of stress in the market, the correlation actually does go up quite a bit. So in some sense, this is a very kind of favorable type of correlation structure that we are seeing emerging. And then finally, I want to say one other thing about the store of value aspect, which is this is something that many crypto enthusiasts are pointing to right now, right? Which is that the Sharpe ratio of Bitcoin over the last years has been very high. But I think kind of this is something where we have to as you pointed out at the beginning, Markus, right? We need to understand, is this Sharpe ratio due to any predictive activity or just the expectation of other adoption? And it looks that the current high valuation really is built on the expectations that say, especially countries like the US, might allow public institutions to invest in Bitcoin. And that would, of course, bring new and very price insensitive capital to the market. But that should be very concerning. Especially, right, and Markus pointed this out at the beginning of the talk too, is that it is not clear that once everyone who could adopt Bitcoin has adopted Bitcoin, whether it will still have, you know, a high Sharpe ratio, given that it is an unproductive asset that in itself, right, doesn't hedge against any other fundamental risk. So this is kind of why, you know, the diversification benefits are limited. All right. So with this in the back of your mind, and I, you know, kind of, I just wanted to make, you know, in a way, build up to then the question of regulation. I want to think about, you know, kind of what really is at stake for regulators. But when I say regulators, it is the public, right? We have regulators because hopefully they work on behalf of the public. And so we want to understand, right, what are the potential risks that could come from wider adoption? And when I say wider adoption here, I want to be also very clear that I'm not saying that we should ban any investments by individuals or venture capitalists in cryptocurrencies, not at all, right? As Markus said, we do want innovation, we want valuable innovation to happen, but we have seen that massive amounts of money are flowing into venture-backed venture capital vehicles that are investing in fintech and payment applications and cryptocurrencies. So there, you know, this seems like a very healthy environment right now. But what we are seeing is a lot of current pressure on regulators like the SEC and the Fed, and a lot of lobbying to allow regulated financial institutions such as pension funds and mutual funds and publicly traded firms, or even government entities, to transact and speculate in Bitcoin. And, you know, kind of my question in the last, you know, kind of 10 minutes now is, you know, should society be willing to accept those risks? And what are the risks, right, that society is facing, given what I told you about the backbone, so to speak, of the crypto universe? And let me again say, right, this is, first of all, not all crypto is the same. And this is not a talk against innovation. This is not a talk about technology, right? We have seen massive benefits from technology. What I'm really concerned about is the particular type of proof of work you know, kind of a verification profile with the anonymity and basically inability to identify who is transacting on the blockchain. So again, to say, right, that the underlying blockchain technology itself, or applications like smart contracts, can probably in the future have massive value for society. And, you know, kind of, I'm excited to see, you know, what we can do in improving access to finance through those solutions, right? But that should be separated from, you know, speculative vehicles like Bitcoin. And same thing, stable coins, when they are well regulated and backed by government issued currencies, again, a completely different thing, because right there, we might not have the same worries about financial stability and get all the benefits, you know, kind of potential bigger efficiency in the payment system. Right, with this, you know, kind of, so what are the risks that I'm now going on and on about? But to me, this is, you know, kind of, as you probably can feel, is actually really important. And I think we need to be very cognizant about this. So the first thing, right, that I want you to just put into perspective is that there could be an extreme loss of seigniorage benefits to the public. Because if we were to allow Bitcoin to become legal tender, that would either replace or even work in parallel to, you know, say dollar or euro or whatever fiat currency you want to think about, right? It would shift these seigniorage benefits that nowadays go to the public and go to the citizens of a country through, the regulatory environment and the financial system. It would shift it to a few early adopters. And I showed you how concentrated these early adopters are, and also that we don't know who they are. So we're basically handing, these seigniorage benefits to a very small set of entities that not only are concentrated, but also that are entities that have no obligation at all to either provide public good or even stand in front of any public regulation. And these are big numbers, right? People have calculated that, say, the total value of M1 for the G20 economies would be something like $31 trillion.
Yeah. But Antoinette, there's also demand deposits in it. So a large of these benefits probably go to the banking system at the moment. And is this better if it goes to the banking system than to the Bitcoin miners?
So I agree with you that, right, some of this nowadays goes also to the banking system. I think this is why we have a Federal Reserve System. That's why we have a regulatory environment that is where the intent is to protect the public and ultimately to provide a stable financial system that that benefits the public. Is it a perfect system right now? As we have seen, absolutely not, right? We have had incidences where, 2008, where many things failed, including regulation for sure, right? But at least there is accountability or greater accountability to the public, right? While with the Bitcoin miners, the way it stands right now, there is none, right? And let me come to my second point, which is probably very related to what you're saying, which is that, remember also, right, that even if many miners are actually well-meaning and doing everything, in a, even if, many of them, we would know who they are and they are transparent, right? It is a possibility, given how concentrated the mining capacity right now is, right, that, say, you could have disruptions and even create systematic risk if malevolent, either private parties or state actors are trying to take over this mining capacity or attack, right, the mining capacity, and then impose losses on the general public and on the stability of financial institutions, right? And people always, by the way, this is something that's really important to understand. People often say, oh, no, that would never happen because it's in the interest of in the financial interest of the miners to ensure that the system is stable and that people have trust in the system. That's definitely true, right? If miners are only guided by financial incentives. But as we know, right, if there are entities that have non-financial incentives, such as creating havoc in the world financial markets, or retaliating against certain states or citizenships, then they might be willing to take major losses and even lose, say, their future benefit from just holding on to the system in order to create this, right? And so to me, this is actually something we need to be very aware of, that there is this potential for systemic risk. Yeah, does this speak to your question?
So I was just wondering whether, when you talked about loss of seigniorage, you were planning to come back to the El Salvador question, or you want to move it later?
So the El Salvador question to me is indeed, this comes here. So, it is true that if you think about El Salvador, somehow Markus reads my mind. Good. So I would say two things to the El Salvador question. So, right, I mean, for everyone to know, right, it's the president of El Salvador announced that El Salvador in about 90 days is prepared to allow Bitcoin as legal tender, and several big Bitcoin enthusiasts have already kind of sent memes, Mickey Mouse packing to El Salvador, right? So there is some excitement about it. So one thing is, it is true that, say, for El Salvador itself, it might mean that they're giving up seigniorage for their citizens. Now you could say maybe that's not so much in the case of El Salvador, right? Or in the case of Venezuela, where we have maybe seen that Bitcoin is a preferred legal tender relative to their local currency, because potentially you could say that, at least in the current state, the Bitcoin universe is more trustworthy than their government, right? So I'm not ruling this out, that there are these extreme cases where you have extremely dysfunctional governments, right? But that is not true for kind of a government that kind of in a financial system that you might want to trust more. Now, what I think is actually a bigger worry from these type of announcements, as in El Salvador, is actually that it will facilitate the shadow part of the Bitcoin economy to grow even more dramatically. And what do I mean with this, right? It's exactly this point that, imagine most hubs or nodes where Bitcoin leaves the Bitcoin blockchain and moves to other currencies such as dollar, or kind of basically where you exchange Bitcoin to other cash. Imagine there were 7 hubs and they were all Coinbase or Kraken or whatever, basically exchanges that you believe are so well regulated that they impose KYC norms and on kind of all their participants, right? Then you could say that at least there's a hope that most money that leaves the Bitcoin universe has to, in a way, come clean and announce, number one, who is holding it, what's the taxation implications, when was it traded in the past, so how much capital gains did you have, and so on. But of course, that's not where we are. And the more we have countries, say like El Salvador, that will make it legal tender, the easier it is for people who want to stay in the shadow economy to be in the shadow economy. Because now I don't need Coinbase anymore to turn my Bitcoin into dollar, right? I can actually kind of buy and sell with many unregulated entities in places like El Salvador. And so that basically means...
That means essentially a huge demand boost for the El Salvadorian economy, because if I have illegal Bitcoins, I don't want to be seen to transfer it into dollars. I fly to El Salvador and have a nice vacation and spend my Bitcoins there without anybody finding out. If I'm the president of El Salvador, I might attract this illegal money, might boost my own economy. Is this what you're arguing?
In a way, I'm arguing, I don't want to put malintentions into, the president, but I think, kind of this is part of it, kind of, and there is an implicit potential for race to the bottom. But it is also true that even El Salvador should then understand that taxing those flows and even their own citizens will become extremely difficult, because basically we have seen, right, that what I showed you is, given how untraceable the identities behind transactions are, you don't then basically know which tax base you are taxing somebody on, who, kind of, even when they interact with a known entity. And that's actually, kind of a big issue that, kind of, at least the US IRS has, in my opinion, not wrapped their head around fully. And as long as we are not effectively taxing Bitcoin, we are actually massively subsidizing this one type of payment system over many others, right? Because it facilitates tax evasion. Let me, kind of, I know we're almost out of time, so, which is maybe the last thing I want to say, which people have, of course, pointed to, but, kind of, when you have this kind of anonymity, and the fact that you can hide who is behind the ownership of different addresses or accounts, it does give rise, or it facilitates malfeasance. And it facilitates actually different types of malfeasance. There is, what we've seen, right, ransomware, illegal activities, and all this. But there's also a big worry that it will make it easier to basically lobby government officials and regulators to promote the adoption of crypto, because especially at the beginning, when we have this massive price impact that I showed you before, that we have documented, right? It kind of giving a government official donating, right, anonymously some Bitcoin to a government official who then will benefit from the fact that by announcing that Bitcoin can become legal tender, actually, right, has a massive price impact and increase the value of their holdings, creates very questionable incentives. Let me say this at least, right? And there are some worrisome trends even in the US, where local mayors start encouraging the use of Bitcoin for tax payments, or even treating things like buy the dip, which is not clear why a mayor who knows no finance should be engaged in this, right, is very concerning to me. And I feel, that's something that we need to be aware of, that those things also play a role here.
So answering your question, early adopters are the big winners, or
so yeah,
rather than asset managers.
Right. So to me, I think what I would say, just to finish as a takeaway, right? Number one, as we discussed, Bitcoin is predominantly a speculative assets, given its, what I showed you about its usage and statistical properties. It's tough to believe that it would ever be more than that, and in particular that it would be a true store of value. But to me, the really, but I remember, I'm an economist. I'm a Chicago trained economist. If people want to knowingly gamble on things that they understand that they're gambling, if this was a cordoned off environment, where people, if they want to do speculation, that's not for me to decide, right? But
even if it's addictive gambling.
Huh?
Even if gambling's addictive.
Well, I don't recommend it, not at all, right? I'm not saying that. I'm just saying that I don't feel I'm in a position to tell people what they should do. But on their private money and on their private accounts. But what I think is very important to understand is that this kind of big push that regulators are enduring right now, if you want, or the pressure on regulators to allow public institutions, pension funds, mutual funds, even say the use of Bitcoin by publicly traded firms to use it as a legal tender. To me, that is extremely dangerous. And what I've shown you, I hope, is that it's really not in the interest of the general public, because, right, the loss of seigniorage will benefit mainly the very early adopters, and and in particular the very large and concentrated early adopters. And we will see persistent risks to financial stability, maybe even national security, and malfeasance, because it's built into the structure of this cryptocurrency. Even if it was to become say now larger and more widely adopted, it's not I hope I have shown you that doesn't mean that the kinks that many people right now say, oh, these are kinks that will be ironed out. It's not clear at all that they will be ironed out. In fact, they might become even more dramatic, because you will now have this opportunity to have a shadow economy next to the kind of white economy that will make it even easier to transact in this type of tender, if it was to become that. So I think that's all I got.
Thanks a lot. So I have a few questions which I collected. So Bill Janeway and also Mark Rimblad, they were asking, all what you said, is it primarily concerning proof of work currencies or proof of work blockchains or currencies which are based on proof of work? What happens if you go to proof of stake blockchain technology, like Ethereum, Solana, and Divinity, and so forth? Mm-hmm. Would your problems be the same, or would they go away? Are these kinks? Is the only kink proof of work? we were talking about?
So I would say what would go, some of what would go. So for example, if you think about permission blockchains, right, a lot of the things would go away, obviously, right? A lot of the concerns. Now, kind of proof of stake, I think, the inefficiencies in terms of environmental impact would go away. I think you could have more accountability of, kind of these more centralized, miners or kind of basically verification entities. You could have this then, right? But then of course you are losing, then they become regulated entities. And as you said at the very beginning, right, then you do have to now believe that, kind of you will be relying on the ability to regulate these entities. I think, kind of the part where we have to see, kind of is the anonymity of the accounts or the addresses transacting on these platforms. Even there is heterogeneity between the different, right, from Ripple all the way to the ones you mentioned, right? And I think the anonymity itself is something that is concerning for, kind of, as I said, kind of utilization for malfeasance and for tax evasion.
So some other questions are, if Bitcoin is not scalable because of the technological limitations of Bitcoin, so how can El Salvador then run its economy on Bitcoin? I mean, of course, you can take a lot of transactions on Bitcoin, but it cannot scale it up in a sense. Isn't this naturally constraining already how big the shadow economy in El Salvador and somewhere else can grow? And you have to always go outside of the Bitcoin universe in order to do some transactions, or you have some intermediaries which do it for you, like PayPal. So on PayPal is just doing a few transactions, but most of the transactions are done among PayPal customers.
Right. So let me say two things, right? There is Bitcoins, and then, kind of kind of as in normal money, right? You could say then there will be velocity changing, yes, right? And, kind of you have on the one hand, kind of more and quicker transactions within Bitcoin. Now there is a limitation because the protocol by design is slow, right? You have this 10-minute increments. So this again, right, if you really were to run everything on Bitcoin, right, paying quickly in a few seconds, as you do normally in a store, right, becomes actually tougher. You might have to stand there for a while until the merchant is actually sure.
Buying a cup of coffee, and it might take you $30, whatever it costs to do the transaction.
Absolutely. So there's also this part. This is the second thing I was going to say, right? Right now, a lot of the transactions are still subsidized by the fact that Bitcoins are still being issued to the miners, and because they are high value, we have seen so much inflow of that mining capacity now, right? Once that stops, right, at 21 million, you have to pay for the transactions. And so then we will, kind of in itself, this will be very interesting to see the equilibrium that we end up with, right, of, kind of how people will, in a way, structure the fees that they're bidding for quicker resolution, or whether we will have a tiering of, kind of that type. But kind of, I think, kind of for practical purposes, it will be very tough to run an economy, and all transactions on the blockchain.
So there's another question by Lars Görlich. Essentially, you talked a lot about seigniorage losses for the public sector. But I think the bigger thing is to lose the power of monetary policy. You can't stimulate the economy anymore. And he would like to know, where do you see Bitcoin denominated bonds or loans coming out in the future, like Tesla or somebody issuing Bitcoin bonds? Or do you think that's far away and you will not see it? And would you step down as a regulator saying, oh, Bitcoin denominated bonds are not allowed?
So I personally, first of all, I completely agree, right, that there's, kind of limitations to monetary policy. If you handed it over to, kind of the non-Federal Reserve, I didn't want to bring this up because, you know, that's maybe a even more ephemeral, though extremely important, you know, kind of dimension. In terms of, you know, kind of, do I see this on the horizon? That really will depend on how regulation shapes up. I'm personally hoping not, because, right, everything what I've told you so far is the more we actually kind of move something like Bitcoin closer to legal tender, all these risks that I was describing, you know, become kind of more prevalent.
Then I guess I'll stop with the last question. Then you typically end at a positive note. So you have to give us a positive aspect to it and an outlook. Saul Kaplan would like to know, you know, the introduction of CBDC. How do you see that? Is this, you know, a competition to the Bitcoin world? Do you see CBDC interacting with Bitcoins, or even should CBDCs, central bank digital currencies, also be done at the blockchain technology? Just the interaction between cryptocurrencies and CBDC. Do you have any perspective on that? And then you give us a positive path forward.
Right. So yeah, that's a very good question, right? I mean, we have seen that, say, just general stable coins, not necessarily central bank stable coins, right? So they, like Tether, have, you know, kind of course, facilitated a lot of trading. And, you know, kind of, I would say that, and that's why I had said before, stable coins to me, when they are well regulated and backed by government sponsored currency, I feel, especially if we could have, you know, if we move to say a blockchain that is more sophisticated than the Bitcoin blockchain, right, where we can write smart contracts, where we can actually, you know, kind of solve problems of moral hazard at first selection, you know, kind of all these type of things could be massively beneficial. In fact, I would almost venture to say that, to me, that's somewhat close to what, say, mobile money in many emerging markets have done, right? Where, you know, kind of you're now trading minutes or sending minutes to your grandma, right, somewhere in the countryside. And of course, where it has worked well, like Kenya or Tanzania, is because the cell phone carriers have to back the minutes with one-for-one with kind of fiat currency, right? So, you know, kind of, so the central bank, you know, kind of stable coin, I would say that
just to enrich the final positive note, if you have any recommendations to PhD students to do research in this space, would you advise them to do it, and which direction would you advise them to do it, together with your positive outlook where the world is going and where research should be going for PhD students who are looking for topics and things like that?
Yeah. So yeah, on the positive note, as I said before, right, I am a technology enthusiast. I'm not a Luddite. So I do believe, as you know, kind of Markus said at the beginning, while I would be concerned if Bitcoin was the cryptocurrency we somehow allow as parallel legal tender. I think that the blockchain and cryptography are super important, and they can provide lots of solutions, you know, especially for payment systems, you know, kind of broadly defined, because it is quite pathetic, right, that we're still in the 21st century and it's almost impossible to quickly send money from one bank in one part of the world to another, even civilized part of the world, and that there's massive transfers, or, you know, kind of rents being transferred for these somewhat simple transactions. So I think, you know, that is all, you know, kind of, to me, very hopeful, and, you know, kind of safe payment systems will be, you know, super important. For PhD students, I honestly think there should be, and we're starting seeing this, right? To me, the really hopeful and important thing forward is for people to think how technology changes the accessibility of finance and how retail individuals transact with finance. Because, you know, we've already started seeing this in fintech, right? But the more we go towards decentralization, easy access, non-intermediated access, right? Whether it's in payment systems, but the same is now true, say, you know, kind of in financial advice, in savings mechanisms, in your credit cards, and so on, right? These are all things where we really need to understand the way people process risks, understand financial systems with the supply side of these type of products, and who will be winners and losers, and how can we smartly regulate this environment without indeed stifling innovation, but also protecting, in particular, the broader public that doesn't have a PhD in finance and should not have a PhD in finance in order to safely interact with the financial system.
Okay, thanks a lot, Antoinette. A fantastic positive outlook and also a fantastic presentation. Thanks a lot. And we're looking forward to reading all the papers you will produce in this space in the following months and weeks, perhaps years. And I hope to see you soon in the real world. Thanks again.
Absolutely.
Bye-bye.
Thank you for your interest and stay safe.
Stay safe, yes.